After several years of slow growth, in 2015, the global economy is showing signs of recovery. Growth over the next 5 years is expected to outpace what the world has seen since the financial crisis. While Europe underperforms, the United States and Asia show positive signs. And in Africa, strong growth has continued. For instance, despite the downturn in commodity prices, recent IMF figures forecast that Kenya's growth should pick up, and even oil-reliant Nigeria should still grow 10% by 2016. Globally, nominal GDP should increase by more than $30 trillion before the end of this decade. In spite of worries about technological stagnation, advances in many fields are accelerating. Patent applications have nearly tripled in the last 20 years. But will economic growth translate into investment returns? Over the long term, GDP growth and stock market performance show limited correlation, and the returns can be highly volatile. Stock markets have rallied, and many exchanges are floating around all-time highs. But are things too frothy? That depends on the metrics applied. American corporate profits are near record highs as a share of GDP, and the price-earnings ratio is still within historic norms. But implied discount rates are decidedly low, suggesting either persistent optimism or a lack of better options. In the UK, the FTSE is above 7,000, near record highs. But is this a bubble? From 1900 to 2014, UK equities have returned an annual 5.3% after inflation. However, since 1999, the FTSE has delivered almost no capital gains. After including reinvested dividends, this rises to 3.4%. A potentially volatile market offers all-time highs despite below-average returns. Crucially, while year-to-year stock market performance is driven by capital appreciation, long-run returns are heavily influenced by reinvested dividends. Dividends may be even more vital as investors struggle to find a decent yield. Bonds continue to offer meager returns, as the world has experienced years of loose monetary policy. But while the returns are limited, the risks are not, and the direction of the world's most important central banks is set to bifurcate further throughout the year. Shocks, even from supposedly stable markets, are lurking in the wings. A range of major markets have entered deflation. And while the long-term outlook seems positive, the path will likely be fraught. Although history can serve as a guide, the unprecedented occurs with surprising regularity, turning expectations on their head. The route forward is to understand your risk tolerance, to watch for unexpected connections, and plan to be surprised.